Emergency bulletin. Picture this. Your screen is glowing in a dark room. One chart is screaming, one headline is calm, and somewhere in the middle, the public is getting hypnotized by a number. That number is 120. Not because 120 is magical, but because human brains are. If you only remember one thing from this video, remember this. The biggest mistakes in silver do not happen when price is boring. They happen right after a headline number hits, and everyone starts congratulating themselves like the game is already won. As I am recording this, it is January 29th, 2026. The Federal Reserve just held rates steady on January 28th, and silver is acting like it heard a different message than the one the headlines are selling. Drop a comment with the country you are watching from and the time on your clock. I want to see how global this audience really is. And quick note, the stats show a huge chunk of people watching these updates have not subscribed yet. If you get value from real-world market talk with no hype and no panic, hit subscribe so you do not miss the next update. Today we are doing 3 things, fast and clean. 1. What the January 28th Fed pause changed in the plumbing. 2. Why 120 silver is a warning sign, not just a target. 3. The survival checklist. Paper, physical, and counterparty risk, without conspiracy and without panic. Let us go. The pause that feels calm but is not. On January 28, 2026, the Fed kept the policy rate in the 3.50% to 3.75% range. The statement language was basically, growth is solid, the labor market is stabilizing, inflation is still elevated, and they can afford patience. Most people hear that and think, nothing changed. But markets do not trade the words. Markets trade the second-order effects. A pause changes the story the crowd tells itself. When policy stops tightening while inflation remains above target, you get a new set of behaviors. Cash feels less like a reward and more like a question. Duration feels less like a safe harbor and more like a trapdoor. Real assets start behaving like pressure valves, and that is the key idea. Silver is not just a metal. Silver is a pressure valve between two worlds that do not agree with each other. The paper world, where price is discovered in contracts. The physical world, where ounces are consumed, moved, and stocked. A pause does not remove stress. It relocates stress. So here's the first warning sign. If silver accelerates right after a policy pause, the market is not celebrating. The market is repricing confidence, not political confidence, not opinions. Pure mechanical confidence. The belief that tomorrow's currency buys roughly what today's currency buys. When that belief wobbles, capital migrates. And silver reacts quickly because it sits at the intersection of money psychology and industrial necessity. That makes it volatile. That makes it loud. That makes it useful. But it also makes it a trap for people who confuse motion with safety. Why? 120. Silver is a warning sign. A rising silver price is not automatically good. A rising silver price can be an alarm, especially when it rises in a way that feels too fast, too clean, too inevitable. Here is the trap at 120. Round numbers do 3 things at the same time. They attract new buyers. They trigger option hedging. They expose leverage. Let me translate that into plain language. When silver approaches a round number, traders pile into calls, shorts pile into strikes, and dealers hedge. That hedging can create a feedback loop where small moves get amplified. Then the exchange risk teams look at volatility and say, this is getting hot. And when markets get hot, the system cools them with 2 weapons, margin and liquidity. Margin is the silent assassin of late buyers. Liquidity is the oxygen of the market. When margin requirements rise or liquidity thins, the weakest hands do not choose to sell, they get forced to sell. That is why you can see a vertical drop that looks irrational if you are only thinking about supply and demand. The market is not debating whether silver is valuable. The market is liquidating whoever cannot survive. So the warning sign is not 120 itself. The warning sign is behavior around 120. Here are the behavior tells that matter. Tell 1. Ranges expand. If daily candles start widening fast, stress is rising. Tell 2. Dips stop bouncing cleanly. Healthy digestion looks like quick support tests and fast recoveries. Breaking looks like failed bounces and slow heavy price. Tell 3. The paper and physical worlds drift. If spot pulls back but real-world premiums do not, that is not normal. That is friction. Friction is information. Tell 4. Everyone starts saying it cannot go down. That sentence is how bull markets steal money. Because the truth in silver is simple. Silver can drop hard, even inside a real bull cycle. And that drop is designed by structure, not by malice, to shake out weak hands. Now, I want to address the title directly. The Powell Trap, without the fairy tale. The Powell Trap is not that one person flips a secret switch to trick you. The Powell Trap is that people focus on the theater of policy decisions and they ignore the downstream mechanics. If you watch only the headline, you will hear, rates paused. Everything is fine. If you watch the plumbing, you will see, The currency is the measuring stick. If the measuring stick wobbles, nominal prices rise, and the public starts chasing the rising things, not realizing why they are rising. That is the trap. Silver becomes the loud chart. Silver becomes the viral candle. Silver becomes the distraction, not because anyone planned it, but because humans chase motion when they are scared. While everyone argues about 120, they ignore the deeper shift. More participants begin treating the dollar as a trading instrument, not a savings instrument. That does not mean the dollar vanishes. It means behavior shifts at the margin, and margins move markets. So the real question is not, is the Fed bullish or bearish? The real question is, what is the system trying to price but cannot say out loud? And the answer is usually future purchasing power. Now let us get practical, because the whole point of this channel is survival through volatility. The survival checklist. Read this twice. 1. Separate price from access. Spot price is not the same as can I actually get ounces at that price? In tight markets, access becomes the real price. 2. Know what you own. If you own paper claims, understand the settlement rules. Most paper products are designed for financial settlement. That does not make them useless, but it does change the risk. Do not confuse exposure with possession. 3. Respect counterparty risk. Counterparty risk means your gain depends on someone else performing. In calm times, nobody cares. In stress times, everyone cares. 4. Avoid leverage. Silver punishes leverage. If you cannot hold through a nasty wick, you do not have a position, you have a loan. 5. Decide your purpose before emotions arrive. Is your silver insurance you hold through chaos? A trade you plan to sell into spikes? A ratio tool you may swap later? If you do not define purpose, the market will define it for you. 6. Build for 3 routes, not 1. Route A, grind up, ugly dips, higher highs. Route B, stall out, boredom shakes people out. Route C, punch in the mouth, a funding squeeze hits everything and silver drops with it. If you are only prepared for Route A, Route C will break you. 7. Watch friction, not influencers. Friction looks like persistent premiums, longer delivery windows, repeated out-of-stock waves, and sudden changes in availability. Charts are opinions. Friction is reality. Now I want to go one level deeper because this is where the warning becomes a map. The mechanism. Why silver moves when liquidity changes. Think of the global system like a city at night. Credit is the streetlight. Liquidity is the electricity. Collateral is the grid. When the grid is stable, the city glows. When the grid strains, the lights flicker. When the grid fails, everyone runs for candles. Silver is a candle in that metaphor, but it is also a wire. It is both a store of value symbol and a real-world conductor. That dual role makes it sensitive to liquidity shocks. When funding is easy, people buy risk assets, use leverage, and treat metals as secondary. When funding tightens, people sell what they can, not what they want. And when trust erodes, people reprice promises. That is why you can see silver rise in the middle of a messy macro environment, not because the world is getting healthier, but because the pricing of safety is changing. So do not get hypnotized by the candle. Ask what the candle is telling you. Now, here's a quick field guide you can use this week. The field guide. What I'm watching now, indicator 1, real yields. If real yields slide, metals breathe easier. If real yields spike, metals can get punched. Indicator 2, the dollar as a measuring stick. If the dollar weakens at the margin, nominal prices can look like breakouts. That does not automatically mean real purchasing power gains. It means the ruler is bending. Indicator 3, correlations. If stocks, bonds, and crypto start moving together, that is not normal. That is forced selling. That is collateral stress. Indicator 4, the gold-silver relationship. The ratio is not prophecy, it is a thermometer. Sharp ratio moves can reset positioning before the next burst. Indicator 5, physical friction, premiums, delays, and wholesale availability. That is the real-world vote. Now, because people always ask, what do I do with this? I am not giving financial advice. I am giving a framework. 3 viewer types, 3 frameworks. If you own 0 silver, do not wait for the perfect entry. Markets do not hand you perfect entries on schedule. They hand you uncomfortable entries. Use rules, stagger, small bites. Never use money you might need quickly. If you own some silver, stop thinking in one outcome. Decide which portion is insurance and which portion is flexible. Insurance is held through noise. Flexible is managed with rules. Noise is what breaks people who mix the two. If you are heavily exposed, your enemy is forced selling. Do not become a forced seller. That means keep liquidity, reduce leverage, reduce obligations that can trigger a liquidation. In silver, surviving is winning. Now let me address the most dangerous sentence in this entire market. Silver is running, so I need to do something right now. No, You need to do something before you feel that sentence. You need to build the plan while your hands are steady, because silver will test you. It will punish certainty. It will reward preparation. The warning sign, in one line. If silver is screaming higher while credit conditions are tightening, you are not watching comfort. You are watching repricing, and repricing creates two groups, prepared holders and forced sellers. The part most people miss, when money changes jobs. There is a quiet concept that sits behind almost every large move in metals. Money has jobs. Sometimes money is used to grow. Sometimes money is used to speculate. Sometimes money is used to hide. When central banks pause while inflation remains above target, money slowly changes jobs. It stops seeking maximum growth. It starts seeking minimum regret. That shift is not a headline. It is a migration. You can often see it in small signals before it shows up in big prices. More demand for short-term safety, even as long-term confidence weakens. More focus on settlement and custody, not just returns. More interest in assets that do not require permission to exist. Silver benefits from that shift because it is small enough to move quickly and important enough to be chased. But here is the uncomfortable truth. A market that is small and important does not move smoothly. It moves violently. That violence is the trap. The distraction effect. Why silver gets loud when other things get weak. When the public senses stress, it looks for one story to hold, one chart, one villain, one hero, one number. Silver offers that. It is visual. It is emotional. It is simple to talk about. And that simplicity can distract you from the boring, deadly part of the system. Collateral. In modern markets, collateral is the heartbeat. When collateral is abundant, risk assets float. When collateral is scarce, everything gets heavy. So here is a key idea to keep on your desk. A silver spike can be a symptom of collateral stress elsewhere. Not always, but often. Because when confidence in long-dated paper promises weakens, the system looks for substitutes, shorter duration, higher quality, and in some cases, hard assets. That does not mean silver is the answer. It means silver is one of the thermometers. The clean mechanics. What a pause does to expectations. A pause does two dangerous things to expectations. First, it tells the market. The next move is not guaranteed. That uncertainty widens distribution. Wider distribution means wider ranges. Second, it tells the market, policy may tolerate higher inflation for longer. If that is the perception, even slightly, then future real purchasing power becomes the debate. You do not need to believe any dramatic narrative to understand this. It is simple math. If prices rise faster than your yield, you lose purchasing power. That loss forces behavior changes. Some people downshift consumption. Some people chase risk. Some people buy hard assets. All of them are reacting to the same pressure. That is why I call it a trap. Not because someone is plotting, because the pressure forces the same predictable human mistakes. The 5 myths that get people wiped out in silver. Myth 1. If silver is up, it is safe. Up is not safe. Up is often the most dangerous moment. Myth 2. If the Fed pauses, metals only go up. Metals can drop hard in a pause if liquidity tightens. Policy is one input, funding is another. Myth 3. Spot price equals reality. In tight markets, the real-world price is spot plus friction. Friction is premiums, delays, and availability. Myth 4. I can always exit. In a thin, fast market, exits can vanish. Do not build a plan that requires perfect execution. Myth 5. I will know when the top is in. No, you will feel emotions. That is not the same as knowledge. The top is usually a process, not a print. The 7-day timeline. What to watch next without obsessing. Day 1 to 2. Look for whether volatility stays elevated even on quiet news days. If it does, positioning is unstable. Day 3 to 4, watch whether dips are bought quickly or slowly. Fast dip buying suggests strong hands are active. Slow dip buying suggests liquidity is thinning. Day 5 to 7, watch whether physical friction narrows or stays wide. If friction stays wide, the paper pullbacks do not fix the real-world tightness. Again, not predictions, a checklist. The practical protocol, how to think like a risk manager. This is what I personally do when silver is near a headline number. Rule 1. I separate my stack into 2 mental boxes. Box A, insurance. I do not touch it. Box B, flexible. I manage it with rules. Rule 2. I measure stress by behavior, not opinion. Behavior is, ranges, liquidity gaps, premiums, availability. Rule 3. I refuse to become a forced seller. That means no leverage, no fragile obligations, and enough liquidity to wait. Rule 4. I do not chase. I build entries with time, not with emotions. Rule 5. I keep receipts and documentation. If you ever need to prove cost, basis, custody, or ownership, chaos is not the moment to start searching for paperwork. Now, one more important note, because people confuse it. Owning silver is not the same as owning a silver story. Stories change every week. Ounces do not. If you are here for a story, you will overtrade. If you are here for a plan, you will outlast. Now we can return to the core warning and make it sharper. The reserve confidence angle. Say it without drama. People hear the phrase reserve currency and their brain jumps to headlines. Forget headlines. Think function. A reserve asset is simply the thing institutions prefer to hold because it is liquid, widely accepted, and trusted in settlement. When confidence is high, institutions hold more of it. When confidence is questioned, institutions diversify. Not overnight, not with speeches, but with small allocation changes. Small allocation changes matter because the base is gigantic. So if you ever see silver pushing into a new price regime at the same time the market is debating future purchasing power, you are watching a subtle shift in preference. Again, not a collapse, not an apocalypse, a shift. And shifts are what move multi-year trends. That is why I call $120 a warning sign. It is not the number, it is the message. More participants are hedging the measuring stick itself. How price can drop hard even in a bull market. Let me warn you about the most painful surprise in silver. Silver can rip higher, then drop like a trapdoor, and then rip higher again. Why? Because silver trades in a market structure that punishes crowded positioning. When too many people pile in late with tight stops, the market finds those stops. Not because it hates you, but because stop orders are liquidity. A stop order is basically you volunteering to sell into weakness. If enough people volunteer, the drop becomes violent. So if you are buying silver for long-term reasons, your job is not to predict the next wick. Your job is to avoid placing yourself where a normal shakeout ruins you. That means size positions like an adult, leave room for volatility, and never confuse a pullback with betrayal. On-screen visuals you can use, while I say warning sign, put this on screen. A calm Fed headline on the left, a rising silver chart on the right. Then one line, the pressure moved, then show, a ruler bending. Caption, when the ruler bends, numbers lie. Then show, a staircase with cracks. Caption, staircase in an earthquake. Those visuals lock the concept in the viewer's mind. Now back to you, the audience. If you are still here, comment one word, plan. Because the people who survive this cycle are not the loudest. They are the most prepared. Ask yourself, if silver drops 12% in a day, do I panic? If premiums stay high while spot falls, do I understand why? If a broker changes terms, am I exposed to that decision? If the move takes 3 months, not 3 days, can I hold? If any answer is no, slow down. Your goal is not to win this week. Your goal is to still be standing when the crowd realizes what the warning sign meant. Now let us close this the way we started, with the mechanism. Bookmark this update. When silver prints the next wild candle, come back and reread the checklist. The trap is always the same. Emotion first, plan later. Flip it. Plan first, emotion later. That is how you keep your ounces and your peace. Stay sharp, stay patient, stay solvent, and done.